both, starting Yves and start Yves Veggie Cuisine and Vega, you decided to take the plunge. And in the early days, cash is always king in a business, but in the early days, it's even more important. So maybe starting with you, Yves, maybe you can share a little bit. There's personal savings, there's friends and family, there's banks, although banks aren't super receptive at the early stages. Maybe give us a little sense of how you looked at that and how you raised capital for Yves in the early days.
Yeah, well, you have to go back 35 years ago when you were telling anybody that you were going to trying to raise money to do a veggie dog. People look at you like, what? You've been smoking something? My family told me that, actually. My brother told me that. He says, hey, brother, what's going on with you? Is everything okay? So I actually had, I tried to raise money, but nobody wanted to. There was no money. So I had $5,000 saving, and my family and friend, I raised another 10 from them. And then there was a program from the government, guaranteed loan for small business. That was $25,000. So I started with $40,000, and actually I was profitable day one. I mean, I was paying myself $5,000 a year, but I was profitable. And so my first business, my bankers were my partner. So if you do look at the business model, we grew 50% per year for 13 years in a row. So the business book tell you it's impossible to generate enough profit, and the ratio don't work. That's why I had to change bank 5 times, because the ratio never worked, debt to equity. And so you go to the next banker. So I've never had any partner, and my first business and my second business, well, I sold my first business, so I had capital to grow the second business, and then eventually I went to get some private equity.
Right. And Charles, you have a similar story in the sense of you really went all in with your savings and whatnot. So maybe you can share a little bit of that in the early days.
I had more money saved up than Yves. I had $100,000, which was my life savings. I quit my job when I got $100,000 saved up. That's I said I'm going to do it when I have that, because I felt that would be enough, and I was so wrong. That was gone the first few months, and then I maxed out all my credit cards for about another 20 or 30. And then I got a total line of credit on my home, which produced about another 30 or 40. And then I sold my Toyota 4Runner off-road machine for another $27,000. I remember that number distinctly, because I had to share my wife's little Presidia hatchback for 5 months, because literally that kept lights on. So I was all in, and really the key thing about not raising money early, first of all, no one wanted to invest in me anyways, so that didn't matter, and no banks would touch me, but was I kept equity, right. And by having a really strong cash conversion cycle, I was able to, like Yves said, self-invest. And so we were profitable from day one too, even though I didn't pay myself very much, through reinvestment of capital. So we had really good gross margins. This industry is known for that. Yeah. We collected fast, we paid slow through negotiation, not through being delinquent. And we had really good inventory turnover. So we're able to keep growing, same thing with you, 50 to 100% year over year, every year all the way through. And no outside investors until year 10, and we were doing by that time $25 million or something like that. So I know 100%. So I think that's one of those things where early on, if you can defer it by having strong cash management, you'll own more and keep more. Like you've kept 100%, that's freaking awesome.
And I think that's a key lesson, I think, for entrepreneur. I hear that, oh, do you want some share? Entrepreneur think share are worth nothing in the beginning. And they want to give share to, for whatever, my accountant, I'm giving him a share, or my lawyers, not to gang up on you guys. But, shares you have to keep them as much as possible for the longest as possible.
So in today's environment, you hear there's low interest rates, there's a lot of hot money flying around. It seems like raising capital is maybe not the hardest part, but what I'm hearing is giving away a lot of that cap table. We see businesses that have broken cap tables and they're barely making any money yet. What's different today? What advice would you have? We'll start with you, Yves. What's different today, and what advice would you give on?
Well, sometimes too much money is as bad as not enough money.
Yeah.
And we just acquired a business. They raised $5 million and they gone within 2 years, because those people. And so sometimes a little bit of suffering does help in the beginning. You know, like you need to really have everything tight. So, yes, sometimes crazy valuation and too much money up front is not good. But trying to keep as much equity as possible is, so raise only the money that you need, I would say, in the beginning. Don't go for 10 million raise if you're going to need 2 million in the next 2 years, you know.
Right.
Proof of concept, and don't get your investor on your back too quickly.
Right.
What do you think, Jay?
I totally agree. Yeah, I mean, if you haven't done all these other things we talked about first, like be all in and have really a strong cash conversion and really have your business tight, like Yves said, if you don't have that done first, you shouldn't be raising money, right? Because you haven't done the work yet. And if you raise too money too early, and you dilute early, and then you haven't solved these problems, then then there's a clock ticking on that money. Versus figuring out yourself, you're much more investable. And really, investors want to see that you're all in and that you've done that work. So that's the biggest thing I see, as because money's easy to come by these days. You see entrepreneurs that come in that just aren't as prepared and as organized as maybe they would have had to if they had much more limited resources and all their own money, for example. You know, easy come, easy go, right? Like if you raise the money really easily, then it goes out the door a lot easier than if you had to save it over a long period of time.
Right.
Anything you'd sternly advise against as companies are looking to raise capital?
You know, I think the biggest thing is the sort of that dichotomy between, hey, can I get the highest valuation, but then what are the hooks or conditions of that money, versus do I want to have the best partner, which maybe is going to have better terms, but maybe the valuation won't be as high.
Yeah.
I think that's something to look at. We both had experiences on either side of things where if you don't have the right fit, things can be much more difficult. You know?
Yeah, I mean, it's a super interesting perspective, because I think right now, what I'm seeing with all sorts of startups is there are rounds of a few $100,000 available for an idea that has kind of a good entrepreneur behind it. And your perspective is very interesting around that. What do you think has changed the last 5 years, 10 years, 15 years? Because with plant-based and natural foods becoming so much more prominent, I think those opportunities are there. What do you guys think has changed, and how do you think? I'm very bullish on Vancouver and our lifestyle and what it means for the trends that are there, and the talent from companies like yourselves that have sold and built talent and built equity, and people are reinvesting, they're advising, they're mentoring. What do you see around that shifting, and how do you think the world looks at Canada and even just BC?
Well, I think what's changed is that there's a lot of companies that realize they can make money with small business, and I would say it's a lot of it is innovation. The traditional brand are dying, and so they need to bring innovation, and they acquire. What we're doing as innovators, we're doing the hard work basically, and we're proving the concept, we're proving the product can grow, we're proving there's a market. And I think the younger generation is willing to vote with the food that they buy, and I think that's the major difference we see. I mean, it's plant-based, but it's all the health craze. I mean, I'm the later part of the baby boomer, and we want to die healthy at 100. But now the younger people, they want to live in a healthy environment. And so they're willing to make a sacrifice or make choice. I think that they're going to see the future in 50 years from now. They're going to be here. Right. So they want the environment to be sustainable. And then the whole movement of healthy, sustainable, I think is here to stay.
Right.
So.
Yeah, I want to add to that. I think that big CPG has pretty much just given up on trying to be on introducing new brands from scratch.
Yes.
It doesn't pay well on quarterly earnings, and no one wants to be out on a limb to see a 3-year wait for something to happen. Instead, it's much cheaper for them to just buy companies.
Right. Yeah.
But they're paying so much that now they're going down market and buying earlier and earlier, and they often have venture arms. They'll reach out early to try and nab you before you get too big and you have to pay the huge multiples.
Right.
So there's no better time right now for smaller businesses to be those innovation hubs or those innovation sources for these big companies. We call them challenger brands, and that's what we invest in because they're doing the job for innovation, and it's a great time. Very, very, a lot of support in the industry, a lot of people in the ecosystem. And as far as locally here, I think we have great talent. I think it's just one of those things where we need to see the successes like the Yves come out, to go, hey, I can do that too, right? And every time we see these exits, like the day of the smart suites, more people say, hey, well, if they can do it, I can do it. Consumer is a new category, I feel like, for Canada. Like we don't have specialists, we're very generalist. In the US, there's dozens and hundreds of consumer specialty funds. So I think that we're going to see more and more consumer. We're going to see that there's a hotbed of talent here in food, in apparel, in tech. Like Vancouver is an awesome place. That,
Well, it's a lifestyle place, and I think
Totally.
the reason I live over here from back east, not only I don't want to be where it's minus 30 in the winter, but I enjoy the outdoor, and the people who live over here usually they have a healthy lifestyle. They want to go and do stuff, so therefore they create business. So I always tell entrepreneurs, look at something that's missing in your life. And then there must be somebody else who's looking for it. Like the idea of Vega, hey, it's good for this, what's his name?
Brendan.
Brendan.
Yeah.
There probably a lot of people are looking for a product like that too. So
Right.